But I do want to move ahead quickly with our awesome panel that we have. Really interesting topic. There was this fantastic journal that Rocio Sanchez-Moyano put together. She's a senior research at the Federal Reserve Bank of San Francisco. She put it together. She was one of the editors with a colleague of hers, and she's going to kind of give a high overview of how we can use fintech for equity and inclusion, and which I call for good. How can we get more? How can we get our friends who don't have assets or the resources that they need to have those resources. Then we're going to be joined by Louis Caditz-Peck. He's Director of Public Policy at LendingClub and happens to be on CAMEO's board of directors. And you all probably know him a lot from the truth in lending stuff we've been doing over the past few years, there's some great things happening on that end, only for another day. And then B. Vohryzek, President and CEO of Community Development Fund. And B used to be our advocate at the state level. So we have a great panel of experts on this topic. And I'm just going to, without further ado, turn it right over to Rocio to tell you about all the different issues that we're dealing with when it comes to fintech.
Great. I had my presentation pulled up and it has gone away, so sorry about that. Let me get the slideshow going again. Okay. Nope.
And just so everybody knows, I think Rocio is at the office. That's not a virtual background. You should take a picture of it for a virtual background.
Yeah, this is my home office. I'm very thankful to have a little bit of spare room at home. Great. So thanks, Heidi. As I mentioned, I'm covering our latest issue of the Community Development Innovation Review. And before I start, I just need to say that the views expressed today are my own and not necessarily those of the Federal Reserve Bank of San Francisco or the Federal Reserve System. And with that said, I will dive right in. So we recently released in August this latest issue of our Community Development Innovation Review on fintech, racial equity, and an inclusive financial system. This was a partnership between the community development and fintech functions at the San Francisco Fed, along with partners at the Aspen Financial Securities Program. And we had 13 authors and 24 contributing articles, as we really focused on, the pandemic highlighted that a lot of people weren't being well served by the financial system. Folks who struggled to make online payments, who were late in receiving stimulus or unemployment checks, or small business owners who struggled to apply for and receive relief loans and other programs. And we saw a lot of variation in this by race and ethnicity. And racial equity is directly connected to the Fed's full employment mandate and our mission to promote a healthy, inclusive, and sustainable economy and to support the nation's financial and payment systems. Research by the Fed and others has revealed that racial and gender-based inequity translates into real economic losses. The San Francisco Fed recently published research that shows that gaps in economic opportunity are costing the US nearly $3 trillion per year in lost economic output. And these cost of these gaps continues to rise. Now, fintech, racial equity, and inclusion were all issue areas that the San Francisco Fed has been working in for some time. But with the pandemic, we saw really an opportunity to dig deeper into understanding exclusion in this area, particularly on the basis of race. And so the purpose of this journal was really to start a conversation across actors in the community development and fintech spaces as we think about racial equity and financial inclusion. So I know a lot of you know a ton about racial equity, so I'm just going to lay a quick foundation so we're all starting from the same page as we think about racial equity in small business. So we know that asset ownership really varies widely by race. Recent research from the Federal Reserve Board found that the median net worth of Black families was just $24,100, Hispanic families $36,100, versus $188,000 for white families. And so that means that for small business owners, they really have a much more limited access of capital within their own personal within their own personal network and their own personal net worth to be able to start a business. Then we couple that with the fact that there's a lot of consumers out there who do not have credit scores or are unscorable under sort of our traditional financial credit scoring system. And again, we see a lot of variation by race. More than a quarter of Black and Hispanic consumers are not scorable. And again, small businesses, in theory, you can get a business credit score, but especially a startup, a lot of times you're going to be relying on the credit score of that individual. And so this can really be a limitation to access to credit. So then when you couple these things, it means that really small business owners of color are not starting from an even playing field. And we see that now in the pandemic. This is data from the 2020 Small Business Credit Survey. And they asked employer firms who had seen, sales declines during the pandemic, what's your likelihood of surviving without any more government assistance? And you can see that Black, Hispanic, and Asian-owned firms are much less confident that they'll be able to survive the pandemic without further assistance because they just have a much more limited pool of credit that they can draw from. And so before moving to the fintech angle, I do want to talk about how do we understand what is an inclusive financial system. And I'll give credit here to this slide to our partners at Aspen. This is all drawn from their article. And they define an inclusive financial system as one that provides everyone, all people and small businesses, with the ability to access, utilize, and reap the benefits of a full suite of financial services that facilitates stability, resilience, and long-term financial security. An inclusive system should target underserved consumers, but in doing so, it should align the incentives for financial institutions and consumers such that underserved consumers get products that add value to them, rather than they as consumers needing to adapt to existing products in the financial ecosystem. An inclusive financial system has a role for consumer protection, but also needs to be forward-thinking or flexible enough to allow for innovation. And although an equitable and universal access serves as the foundation to an inclusive financial system, this system should look beyond financial access and focus predominantly on financial outcomes, including end user stability, resilience, wealth creation, and economic mobility as dominant measures of success. So how do we think about roles for fintech? And here I'm just going to draw some high-level findings from across the articles that are in our journal. But before starting there, what do we think that fintech can contribute here at a high level? And fintech companies are disrupting traditional ways of thinking and ways of banking. And as a result, they can offer an opportunity to reach many who can have been excluded in the financial system. Some of the potential promises of fintech include reaching individuals who don't have physical bank branch locations in their neighborhood, or providing a fuller suite of options to those who can't find the right product at their closest bank. Fintechs might be lowering user costs, either through actual lower fees on accounts or transactions or payments, or by reducing the amount of time and paperwork and hassle that a consumer has to go through just to access services. We can also create new access through new ways of verifying identity and digital identity, and new ways of assessing risk. And in addition, it's been really interesting and exciting to see mission-driven organizations and individuals enter the fintech space, especially those who have been in this space for a long time and who deeply understand community needs. And so there's a lot of opportunity for partnership and deepening understanding coming from various perspectives. And here I just highlight a couple. The first two, SaverLife is a savings app, and they're a nonprofit, and they're featured in our review. And Propel created the Providers app, which is for SNAP beneficiaries. They're actually a for-profit fintech, but they're really working with a marginalized low income and government assistance population. And Connect to Capital, which isn't a true fintech, but rather is a platform created by a CDFI to really bring to match small business owners who are looking for loans to SBA loan providers who are also CDFIs. And so when I think about lessons from our issue of the review, I've sort of split them into three categories. The first is around financial plumbing. So there's a lot that fintech can offer that makes the system work better for users and lenders, and anyone actually who may be providing financial services. Not all of these are, fintech in the way that we think about fintech firms. I'm not talking about, PayPal or Cabbage, But this is fintech in its most basic sense, how we defined it in the issue as anything digitally based, including new technologies, techniques, and business models. When we think about this as advantages potentially for a small business, the first component here is fintech enabling instant payments. So, not needing to wait for those funds to hit your account, or vice versa, you're being able to pay your vendors quickly. Then the second component is really movement around a digital identity system. We typically will think about this in the context of an individual consumer, but it will work for small businesses as well. And there's so much regulation around know your customer and anti-fraud that it can be pretty challenging to get all your documentation and ducks in a row to have your identity proven. And with a digital identity system, that creates an ease in that system. And then all of these things are actually then relying on an underlying open data for finance infrastructure. And so this, an open data for finance system would be one where consumers have a greater control over their data for financial services. And this data can then be shared across providers in a manner that's relatively easy for the consumer. So basically, this open data system facilitates other types of transactions. It lets you share your cash flow data when you apply for a loan, or directs your utility company to share your history of payments to generate credit scores. And that sort of then leads us into number 4, different ways of assessing credit and assessing risk. So not only are some consumers unscorable, but as I said, startup businesses are not going to have sufficient credit history to have their own credit scores. And so we're really having to rely on the personal credit scores of individual owners. By using new types of data, rent data, utilities, cash flow, other forms of data, there's a potential to reduce the number of unscorable consumers. There's also movement to use more real-time data. So the current traditional credit scoring model uses data that has quite a bit of lags. And in a system and in the current economic crisis where lenders weren't sure who had defaulted on an auto loan or defaulted on their student loans or skipped a credit card payment due to the pandemic, they were hesitant to lend because you weren't really sure if this had shown up yet. And so more real-time data will help reduce that hesitancy in lenders and then provide that credit to consumers. And finally, there's a lot of new models being discussed, often leaning on machine learning or AI. These can be particularly useful when we're working with big data, diverse data, data that's changing in real time. There might be new predictive variables that you could input into a more traditional model. But of course, there are some risks and concerns around bias and transparency and management of those models that's part of this conversation. So our next major finding is really learning from experience. I thought it was really important to think about tech that's really designed by and for consumers and communities who are left out of the traditional financial system. We've seen examples of founders with lived experience, and I have some here. Elvis, Grind, and Daylight all target specific audiences with their financial products, and they're created with that audience in mind. And in our issue, the Propel CEO got the idea for his provider's app when he was applying for food stamps and realized how challenging and not digitally based that process was. And as I've mentioned, there's I think a lot of opportunity for mission-oriented fintechs or mission-oriented nonprofits who partner with fintechs. And we have 2 that have contributed to the issue: Acción Opportunity Fund, who partnered with LendingClub, and I know that LendingClub is here to talk about that partnership, so I'm not going to go into detail there. And also Hope Credit Union and the Hope, the whole Hope CDFI network. And so that really leads me to my last real learning from the CDRR, which is the strength of partnerships. So fintechs and CDFIs can have a lot of overlapping and shared interests. Both can be overshadowed by big banks and are an important resource to small businesses. There's also importance in thinking about the use of back-end technologies. And sometimes the way that you're best going to serve your customers with fintech isn't through a shiny new consumer portal, but rather the way that the institutions handle the loans or the applications or the data systems themselves. Hope in their article talks about investing in a software processing tech in order to process PPP loans. This improved their ease and their speed of processing and ultimately allowed them to serve more consumers. Investments in tech and data analytics can help CDFIs and other mission-oriented groups serve customers better and improve an online customer experience that then helps these organizations compete with fintech. And finally, I think there's a big depth of shared expertises. CDFIs can help fintechs expand their credit box or reach other types of consumers, while fintechs can help with customer acquisition and volume when CDFIs and other nonprofits may have more limited marketing budgets. We saw this with Axion Opportunity Fund and LendingClub, but also with Hope and their partnership with their tech vendor StreetShares. StreetShares was able to strengthen their own capacity for PPP loans by working with Hope to reach target customers. But ultimately, some small business customers will struggle with digital only or digital first. And so CAMEO members can really be a bridge here. Hope found that correlations between customers who were the least prepared for the crisis and those who needed the most help with that PPP application. Those customers reported having an easier time at Hope than applying through a fintech lender because they were actually able to talk to a person to get through the loan process. And so the use of tech may free up employee time to then be able to work with some of those customers one-on-one. Axion Opportunity Fund in the California Rebuilding Fund process, which is managed through an online platform, found that a lot of their customers were able to get through all or most of that application online. And so then they were able to serve more customers in this way while still having staff on hand who are available to help. And so with that, I'm going to turn it over to my other panelists, and I look forward to any questions that you all may have for me.
Thanks, Rocio. Oh my God, so much information and got me, I don't even know, lots of information in a very short amount of time. I didn't know about the unscoreable, so that's really interesting. I knew, the invisibles that we've been talking about for a while, so that is very interesting. And what makes an inclusive financial system is also really important and touches upon some of the work we've been doing with Truth in Lending that fits right in there with that. So really kind of interesting the way you put it really pulls it all together and pulls all the issues together. So thank you for that. So yeah, we are gonna move on because there's a lot to talk about here. And so I want to move on to Louis and B so that we can have a good conversation afterwards. So if you can kind of take your notes and write down your talking points, that would be great. So with that, thank you so much, Rocio. Great work. Really, really rich journal. I've looked through it a lot, brings a lot of the articles, it brings a lot of the issues to the forefront. It's really a nice summary. And you gave us the summary. Everybody should be experts by now. So with that, let's talk about how this might work in a mission-driven partnership with Louis. We're going to hand it over to Louis. If anybody, Rocio, are we able to share your slides with the group?
Yeah, go ahead. I think I sent them earlier this week.
Yep. Okay. Yep, you did. And so we can send those out. The SBAs, we'll send the links that are public out to you all, but not the slides, as well as Louis said that we could share his slides. He needs to work it out. If he gets some approvals, we could share his slides. So he'll pop his email into chat. Without further ado, I'm going to hand it over to Louis from LendingClub and the CAMEO board.
Hey guys, I'm Louis Caditz-Peck and really honored to speak. I'm going to speak, although being on the CAMEO board is a great honor, I'm going to speak at the moment with the LendingClub hack because we're going to talk about LendingClub work. And before I do, I just want to say, Rocio, what you were just sharing was so rich and insightful and detailed, and I just want to applaud it, and I hope we can follow up and talk about it more. I will share a few slides, which will be cover some of the stuff similar to Rocio's about what fintech might be able to bring to financial inclusion, and then talk a little bit about the partnership that Rocio referenced that LendingClub has with the CDFI Axion Opportunity Fund. Just maybe a little biography to start. My career has been about half and half in CDFIs and fintech. Started at the CDFI self-help and was doing small business lending there. And two of the sort of lessons from that experience led me to where I've ended up at LendingClub, and one of them was just this validation, which everyone on the call experiences every day, that there's a huge gap in access for small businesses that should be getting good credit. You know, I at Self-Help, I had a portfolio of a couple $100 million of loans to small businesses. They all came to us with decline letters from banks, and they performed on their loans. And so there was this market gap. It needed to be filled. But I also experienced that we lost money making those loans because of the high operational expense. And so we cross-subsidized the small business loans with new market tax credit financing and other activities that generated more revenue. And so that got me thinking, and as I think probably most people on this Zoom are thinking, you know, how do we shift, how do we find new ways of making loans to folks that need and deserve them in a way that is scalable and operationally economically feasible. So that led to approaching LendingClub and saying, hey, you guys are, you're using technology in personal lending to lower the cost of originations and pass on savings to the customer. And that's a lot of what's needed to make small business lending work as a market. And so let's try doing it. And that's where I am today. So just a quick word on LendingClub. LendingClub is now an OCC chartered bank. We became a bank. We merged with a bank called Radius earlier this year. And so now we're both a fintech and a bank. And LendingClub's facilitated about $65 billion in loans. Most of that is to consumers that are refinancing expensive credit card debt into lower rates. But a chunk of it is also in auto lending and small business lending. So just here's some quick evidence at the outset of some of the findings that we've had about fintech and financial inclusion that kind of substantiate some of the things that Rocio was talking about a moment ago. These are two tables that are based on research put out by other researchers at the Federal Reserve. The one on the left is a table. They looked at a bunch of LendingClub data and they measured where those loans were going. And what they found, as you see in the left here, these blue and red bars, is that 25% of the loans through LendingClub were going into the 10% of counties that have the fewest bank branches per capita. And then on the right is a chart that's also kind of explaining some of why that might be happening, which is talking about kind of how Rocio was talking about innovations in credit underwriting using technology might help identify folks that traditional credit underwriting would say are too risky, but in fact they're not. And this category of folks that are thought to be risky, but in fact are not, are referred to in this publication as the invisible prime. And so what you see in this graph here is the percent in which LendingClub's credit model was correlated with FICO score. So when we started, there's an 80% correlation you see. Basically, we were underwriting with FICO scores. And then over time, as we started using more data and more complex data and maybe some novel data and more sophisticated technology in the credit modeling, our opinions about who we could lend to, given their risk, diverged more and more from what FICO would say. And that means that we were finding people that we thought were creditworthy, but FICO would say we're not. And that has helped us lend to folks that, that are in that invisible prime that otherwise would be overpriced or overlooked entirely. And so that correlation fell during this period, you can see from 80% to about 35%. So this is a high level slide, basically recapping some of what Rocio said, but less sophisticated. So here's 4 things that, that we think fintech writ large might be able to do for financial health, pardon me, for financial inclusion. And this is also just want to say, this is not the total picture of fintech. Obviously, a lot of fintech is super varied, and there's tons of different models and products, and there's good ones and there's bad ones. There's a lot of bad things in fintech too, and I think we all hear about those. So, but speaking here about opportunity, number one, What really drives LendingClub the most is reducing operating cost. Basically, we automate a bunch of stuff, and that makes it where in the past, to make a small business loan, you would have, Lewis, the loan officer, write a couple-page memo, make a bespoke Excel model with break-even analysis of what the small business can afford. We package it up with the pro formas and the tax returns, and we make everyone on the credit committee read it, and we meet for an hour, and that's actually delivers really good underwriting. That does not deliver, in my experience, worse underwriting outcomes than fancy fintech credit underwriting. It's just really expensive to do. And so that's still the way that banks underwrite big commercial loans, and I don't see that changing very soon. But it's not economically feasible to do that in a scalable way without subsidy on small loans. And by small, we're talking about even less, 500,000 or 5,000. So when operating costs are reduced, then that does several things. One, you can just reduce the prices you charge customers, and you can improve folks that are otherwise too risky, because there's some cushion created there, and you can maybe profitably do smaller deals that otherwise would have been economically infeasible. I think at different points, we found our break-even point on a loan drop to loan sizes of $15,000. We broke even, and then in one approach, $5,000. And I think for traditional manual underwriting, maybe that's more like 500. That's a ballpark. I haven't seen analysis on that. So that's number one. Number two, improving credit decisioning. We've talked about that, and so did Rocio. Number three, products and experiences can be customized. This one I think is kind of the most amorphous, but kind of the most interesting. When it's kind of a digital version maybe of high touch financial services. When you use a fintech product, there's the potential for a financial services provider to use technology to be able to look at a bunch of data about you and be able to say, hey, Lewis, we think this thing would be particularly helpful for you to use or do, or you can have different products interacting with each other in helpful ways. So instead of having like a loan over here, doing whatever that loan is going to do, and a savings account over here, doing what it's going to do, you could have experiences like, the financial services application helping you decide which loans do you put your money to when, and how to prioritize paying down debt versus savings versus longer term investment. And so I think over time, we're going to see what people think of as a financial service get kind of more abstract and built around people's actual experience and needs, and less about like a product, like this is a loan, this is a checking account, this is a savings account. And then fourth, new business models might focus on market gaps, not because always folks have hearts that are as good as everyone on this Zoom, but because where the market's not doing a good job, there is market opportunity. So some examples of how that's played out at LendingClub, three. Here's the three main lending business lines that LendingClub is in. Now that we're a bank, we're also doing deposits. So one, in personal loans, the thing that's really driven LendingClub's business is that banks are overcharging their customers in credit cards. And so maybe if the average credit card rate, I'm ballparking some numbers here, is about 20%, LendingClub can lend to folks at something like 15%. And it's not in the interests of the banks to lower their prices to compete with us, because then they would have to cannibalize their own business and they would make less money. So, this is what people talk about as the innovator's dilemma. When a business becomes vulnerable to someone else doing a better job, but they can't react, or they start to lose the business that they make money on. And so that gave LendingClub a lot of time, and still, to refinance credit cards and just offer lower prices. And banks are now starting to actually offer competitive installment loans that are of similar prices. Hopefully we still are lower than them. In small business lending, I think we're all here because we know what the market failure is in small business lending. It's that banks don't make loans to small businesses enough. And so we've talked about how technology maybe can help that. And I will take a moment to plug CAMEO has a great program that maybe several folks on this Zoom are already in, to help help use some technology through a partnership with LendingClub, which is a technology provider, to try to be a little more efficient in underwriting and servicing too. And then in auto lending, which LendingClub also does, there's an interesting one. LendingClub does auto refinance lending, because when people get loans from the auto dealer often adds a markup to the loans. And so, as we know, when I go to the auto dealer and I say, Heidi, the auto dealer, like, what can you lend to me at to finance this car? Heidi will then ping Capital One and other banks that do a lot of auto lending, and Capital One will say, hey, we can lend to Lewis at 8%. And the auto dealer will then say, Lewis, great news. Capital One will lend to you at 10%. And they just pocket the 2% difference. And they never tell me that. And so the customer's overpriced. And if the customer's overpriced, they're being charged more than their risk merits, then there's a business opportunity for LendingClub to come in, charge the customer the 8% that they might have actually been able to do based on their risk. And Capital One can't compete with us on that, because Capital One needs to keep the auto dealer happy. If Capital One undercuts the auto dealer or tells the auto dealer that the auto dealer can't add a hidden markup, Capital One is going to lose their marketing channel through their auto dealer. The auto dealer is going to say, that's fine, Capital One, I'm going to ask some other bank. So those are examples of ways that, just whether it's fintech or just other kind of new entrants in the business model, there can be benefits. So I'm going to talk a little bit more now specifically about the partnership with the Axion Opportunity Fund. And I'll also just say it's been one of the great pleasures of my work that, coming from CDFIs, I've been able to keep working with CDFIs and try to bring something back to CDFIs in this partnership. So how it works, in a word, as you see here, is customers come to LendingClub, they apply on our website, we marketed to them, we provide them offers from Opportunity Fund right there. They get run through a credit model that is built on LendingClub and Opportunity Fund data together, that we co-developed together, and it's for an online unsecured small business loan product that the two organizations also developed together. And then the customer goes over to the Axion Opportunity Fund website, they accept the offer, and Opportunity Fund funds and services the loan. So it's like it's grown over time. It started as a decline referral, and it was so successful that it's become a bigger and now really a core part of our small business lending program. And I will now list 4 lessons, and I think this is my last slide, or getting close to it, for what has made this work, in case this is of value to y'all as you think about whether there's partnerships that you would want to explore. The thing that really drove it from the outset, that Rocio also referenced, is fintechs and CDFIs can have very complementary expertise. I think fintech and maybe banking generally can have a certain amount of hubris that, like, hey, we're for profit, we're really great at what we do, we know how to do things, and there's also, so that creates a kind of language gap. There can be kind of a similar experience on the CDFI side, in my experience of saying, we really know how to work with borrowers, and actually these two fields are good at different things, and those things are very complementary, and it helps to have people that have done both or understand both to be able to figure out how to fit those complementary parts together. So I just want to applaud CAMEO for having this conversation to spark more of that. some of the things that are complementary. So stuff that LendingClub was good at was, fast digital underwriting, online customer experience, marketing, that kind of stuff. But there's stuff that LendingClub was bad at. Like, for example, LendingClub had a really high cost of funds. We were selling loans to investors who were trying to make 9 to 12% on the loans. So that is a pretty big disadvantage when you're trying to price the loans. AXIO and Opportunity Fund had a cost of funds of like 2%, and they were not trying to make a particularly high profit, just enough cushion to cover their risk and prove the customer lendable, creditworthy. And so they were able to offer lower prices. AXIO and Opportunity Fund had both the values and expertise to do more high-touch, flexible workouts when customers struggled, and that also reduces losses. They were really good at working with customers directly on the phone. I think you get a different kind of culture in a CDFI that's mission-driven. So they had expertise working with risky folks, and they have reputational credibility to work down the credit spectrum that is harder for a for-profit to do sometimes. So all these things, they were good at stuff that LendingClub wasn't good at, and vice versa. And so we figured out a way to put those things together. And lesson one from that was the common language. It really helped that there were folks at AXIO and Opportunity Fund that had come from fintechs, and vice versa, and LendingClub. And I think this kind of dialogue helps. Lesson number two, common goals. At the time, we were signing partnerships with Google, with Alibaba, with like big companies. But over time, this partnership that we have with the CDFI AXIO and Opportunity Fund has been the one that has been the most enduring and most beneficial to LendingClub's business, because we structured it really closely on the goals of both organizations, really business goals. This was not designed at all from the beginning as how do we do something that'll make LendingClub or AXIO and Opportunity Fund look good. There were particular things we were trying to accomplish. So this is a slide. The reason why it looks so crummy, this one, is because this is just actually an internal slide that we used at the time when we launched this partnership about what LendingClub's goals were within the business line, irrespective of AXIO and Opportunity Fund. And then to evaluate whether we should do this partnership, we went through, and this was a slide we used also to say, hey, does this help us drive any of our goals? We got a new partner. We improved conversion from landing page to issue. This is people that were coming to us. We were basically able to, through the partnership, approve small businesses that we would have declined. So this partnership helps LendingClub make money because LendingClub earns revenue by making loans that it would have otherwise just lost money on and had to decline. Increased efficiency of lead generation. The more of our customers that end up in loans, the lower cost per customer that we acquire. Customer acquisition has turned out to be actually the hardest thing about small business lending for us, as opposed to underwriting. And so, hiring talent. I find this motivating, and I think other people at LendingClub do too, and so on. So compatible scale, here's another one. This is, one of the biggest challenges of CDFI and fintech partnerships is CDFIs have a laudable focus on specific community needs often they're regional. CDFIs are terrible at those things, and they have the good and bad of generally trying to address the entire country with the same tools all at once. And so the scale challenges can be difficult to align. In this case, when we partnered with AXIO and Opportunity Fund, we started with a pilot in California. And then after that pilot was deemed successful, it's now operating pretty much in the whole country, 45 states. And the last lesson that was really important for it to work was we had to have common tools. AXIO and Opportunity Fund, at the time, they had a chief technology officer, they had engineers, and so we were able to work together in the realm of technology. had they not had those things, we wouldn't have been able to have the partnership. And so those are challenges maybe a lot of the time, but things that in this case work to make this partnership effective. And with that, I'll end it and look forward to any conversation later. Thank you so much.
Thanks, Louis. So it's possible is what I hear. And we're going to have another example of what's possible in the future. I know B is going to give us B is working on a project to integrate AI and machine learning into into small business lending, which is super important. She's going to tell us why it's super important. There's been some big news in the last week. And this is happening with us or without us, and it's happening to our clients. So I don't want to steal B's thunder. So B, take it away.
Well, thank you so much. And thank you, Lisa, for handling the slides for me. I do appreciate that. So I can focus on my presentation and be crisp as I've been asked to be. First of all, Louis and Rocio absolutely queued this up. When Rocio talked about the lessons from the partnerships, and she mentioned CDFIs, but she also mentioned mission-based organizations. And this lending score is directed at a very broad nonprofit micro lending audience. So it's not just the CDFIs, it's also the SBA micro lenders. It's the USDA micro lenders. It can also be for loans. We're pretty much looking at loans under 100,000 and how do we provide some efficiencies in that space. So can you go to the next slide for me? So basically, what we have is a technological partnership, what we're working with is a for-profit AI ML company, artificial intelligence, machine learning. I'll just use AI ML to be able to take the current methods that are being used and find a way to find some efficiencies through a scoring process. We started a community development fund. I really jump-started it with Matt DiMichele in October. And the intent was to become a micro lender. And Matt had said early on to me that he thought we ought to be looking at this whole world of technology as a way to do these under $25,000 loans. And so he really got us engaged in this whole conversation. And we ended up, I may not come up with the idea, but I'm pretty good at moving that idea along. And so we, through the year, as I was getting ready to microlend into 2021, I suddenly realized, in all of our conversations, Matt and I looking at different projections and things, that really we saw all of the things that were evident and the challenges of nonprofit microlending. Louis brought up, the cost of funds for Opportunity Fund or Acciona Opportunity Fund. One point I want to make is that the reason their cost of funds is low is because they borrow at a very low rate, like through Wells Fargo or different entities that do EQ2 loans or are just doing a CRA loan at 1%, but also they get grants. And they get a lot of money in grants every year in order to operate. So it is a subsidized industry, as it should be. It's a nonprofit micro-lending industry. It's turning itself towards the disadvantaged communities and disadvantaged small businesses. And so it's appropriate that it's being publicly subsidized. What we want to do at CDF is we want to bring that subsidy down to the extent that we can by using technology to enable that. And so can you go to the next slide for me? So we have a series of goals. If we're going to put together an alternative transparent lending score, or what I'll call Atlas for short, we're going to look at, we want to make sure we can manage risk, because as any nonprofit micro lender knows, they've got to have loss reserves. And if they borrow the money to lend, they've got to pay that money back or negotiate that down when they go to deal with the lender who loaned them $100,000 or $50,000 to relend in micro lending. So what we want to do is give the lender tools to be able to manage that risk and reduce that risk to the extent that they can. In addition, this week alone, there was an announcement that Amazon and Lendistry are teaming up to do loans, small business loans between 10,000 and 100,000. This is right into the micro lending space that many of us, you know, in the nonprofit world are looking at, the ones I already mentioned, the SBA, the CDFI, all of those micro lenders. And so these, you know, behemoths, for lack of a better word, like Amazon, are coming into this space. American Express bought Cabbage during the summer. And so they're entering even more fully into the small business online space. And it's my belief that as a nonprofit community, that we're going to do better by the small businesses because we're mission oriented. That's our entire focus, is how do we stay on mission? But we also have to manage risk. So the goal was to reduce and manage risk, obviously increase fairness. We wanted more financial inclusion, financial justice, as we put together a score that would in fact increase those protected class borrowings, and reduce human element in the sense of, you know, there are biases. Yeah, and certainly with AI, ML, you have to look for biases, and I'll talk about that a little bit later when I talk about the partnership. But additionally, there are biases with people. And so in some way, there's this, you know, you have to watch on both sides. We look at improved efficiency. What we want to do here is to be able to speed up the credit decisioning process and kind of have a red, yellow, green, so that you know the borrowers that are going to need a higher human touch versus those that may, I think it was referenced on the PPP loans, those that actually did just fine in doing their own PPP app. And we'll find the same thing with the credit scoring. There may be some that really just need the money and don't necessarily need a lot of technical assistance. And finally, we really believe as a collaboration, this is about, I'm very happy for, you know, Axion Opportunity Fund that they have LendingClub as a partner and they have this algorithm that they're using, but there are hundreds of other micro lenders, nonprofit micro lenders, and Atlas is looking for them. Atlas is trying to help those that are at 25 loans a year and want to go to 50 loans a year. How can we help them use their human capital more efficiently, and how can we help them scale? So this product is really requires that micro lenders come together for it to be developed. The final development phase involves back testing. It absolutely requires us all to come together, back test 5 years back on micro loans under 100,000. I say 100. I used to think micro loans were under 50, but I was schooled by a couple of California micro lenders that apparently in California things are so expensive. What may be fine in the mid-country in California becomes 100,000 just to start up a small operation. So under 100,000, looking at back testing back 5 years, and we'll go to the next slide in a moment. But the whole point to this is really coming together as a nonprofit community so everyone can benefit. The more micro lenders that we have involved in the back testing of Atlas, the more inclusive it will be in terms of recognizing different parts of the country, different parts of the state of California. And so we want more is better. And ultimately more using the product will also reduce cost across many. And so it will enable for scale, particularly for those larger, smaller organizations. You know, we hear a lot, and I did hear AOF talk about, they were on a Fintech webinar back in September, and he spoke about the two big challenges, and customer acquisition was brought up, and we believe that actual quicker turnaround will help this industry in the sense of customer acquisition. And then second of all, they talked about the cost of technology. It is really expensive. Technology is extremely expensive, which is why we're saying let's come together as a nonprofit micro lending community and make this happen as a community. Next slide. So who do you trust? Okay, there is a lot of, I will say that one of the things I have encountered in my conversations with nonprofit microlenders has been that there is, you know, a certain lack of trust about technology and the whole fintech industry. I don't think that's news to anybody on this Zoom event, and so trust is a big deal. And the partner that we're going with is a partner that is a for-profit company that has as one of its stated goals, fair and inclusive credit for all. They have that mission from the very beginning. And so, and they have been involved in fintech fairness coalitions. So Zest AI is the company that will actually provide the support, meaning the software support, the technology that allows Atlas to function. And so I talk about they're committed to fair and transparent credit to all, and they want to build a more equitable financial system, completely in tune with where us as nonprofit micro lenders are. And I do want to say something to that. At this point, Matt and I are embarking on a journey to simply launch Atlas. I'm not sure that in the end, we will end up doing micro lending. That's a big question at this point. In fact, at this point, it's probably no, because we believe this is so important and so timely. We need to put all of our focus behind the development of this product. They have a patented technology that was created to create more fair credit models that's compliant with laws and regulations like the ECOA. The clients that they have worked with, Discover Credit Card, they're also working with ViStar Credit Union and a series of credit unions, but ViStar has experienced an increase in approvals for their credit card and on top of that, more financial inclusion in those numbers, more approvals among the protected classes. And they're also committed to working with the nonprofit micro lending industry to make this happen. They want this to happen for us, and so they're working with us. And the partnership is there so that within the middle of Atlas will always be a nonprofit entity, and we will have an advisory council that will be a team of nonprofit lenders. So Zest will interact with intermediary CDF, but also CDF will have this council. And so we will always be working with this algorithm and making sure that it continues to stay on point as it will evolve over time. Next slide. And I'll try to make this snappy. Basically, I think I mentioned about the data that we, 5-year back testing for loans under 100,000. There will be no data sharing among these micro lenders. I have offered consultants to help with the upload of the information if an organization feels like they don't have the time, or they just aren't in a place where it's about 8 pieces of data we need from from those loans or those declines going back 5 years. It will be FCRA compliant data and tested for fairness and inclusion, and it will be validated against your existing portfolio. And so what will happen is every organization that is involved in the back testing to develop Atlas will receive a report that will talk about what their portfolio did and what it could have done had those loans been scored under Atlas. Next slide. Please, thank you. And this is just really kind of showing you the process of how you come up with an Atlas score. And I think the important thing to remember is the human being is at the bottom of this. There is always a human being involved. If you get an Atlas score and it's a green and you go to fund, obviously you have humans involved in the approval and any kind of closing issues or the closing process itself, as well as servicing. Humans are not to be eliminated when you have an Atlas. And I think that was mentioned, I think Lewis may have mentioned it, the importance of using the human factor where it is most needed. So we're looking at reduction of cost and greater efficiency, and we believe customer acquisition because of that. This is an unprecedented time in terms of information out there about CDFIs, about community-based organizations, about SBA. I really believe that this is the time to come out and do something like this, because it's the time that people actually have name recognition. And if you can come up with more, with a streamlined process within your organization that saves you time, but also saves you human capital for where they're needed, I think it's a win-win for all. And then the last slide is just to reinforce the community that this is about trying to bring all micro lenders up nationally, and how do we help them to have the technology and to be able to move into this world of fintech, online lending, and be able to compete effectively in terms of their ability to generate the approvals more quickly, and the ones that aren't approved to be able to use their human capital with those. And with that, I will. I think I'm at 10.